Good evening, everyone. I hope you're doing all well. So let us just start. And guys, just want to tell you that I'm still expecting from you to submit the methodology part this week, because next week is the last week of the classes, and I think it's going to be a little bit postponed for some people to submit their article.
One question.
Yes, Janai.
Like after, like who will be checking these conference papers?
I don't know who is going to check the conference papers, but the articles, I'm the one who is going to evaluate.
Okay.
But later we'll submit. Actually, you have already submitted your article, Janai, with Islam. And for the other, we will submit. And you receive some comments. We're going to discuss about that. What comments and what modifications.
Yes. And okay. Yeah.
Okay, then let us continue.
Professor, did you share the screen by any chance?
Just a second.
Okay.
Okay, last time I gave you as a homework, as an assignment, to go over this balance sheet of these two different companies, which is East and West Company. And what we can understood that, and ask you to make the common size balance sheet from it. Like we can see that the balance sheet of East and West, they're differentiating in terms of the size. East, it seems like has got higher total assets than in contrast to the West. So we can make, why we need to make the common size is the first of all to make the standard analysis to understand what's going on with the firm. So what we can see in here, we actually will not be able to compare, to make any analysis on absolute numbers. In order to come up with a proper analysis, we should convert into common size statement. So which means we are converting to percentage. We are getting the items like cash, account receivable, inventory, and so on in terms of total asset as 100%. In this way, we convert it. And this is what you're supposed to get it actually. So comparing here, for example, starting with current assets, like we can see that the current asset is 25% for East and the current assets for West is 23%. We can say kinda, if we said that there is one measurement, we use the working capital that measures liquidity position of the companies. So from that working capital management, we can understand that this is the difference between the current asset and current liability. We can really get it that East has got liquidity position is lower than to the West, because the current liabilities is 22 and 7. We can see the difference is 3% in here, and here we've got like around more than 10% actually, like 16%. So what it tells that West has got higher liquidity position and the East has got lower the liquidity position. So it's not actually the case to come up with the case that yes, it's because this guy is having higher liquidity position and this guy having less liquidity position. So we can just put some sticks, let's say, saying that West is gaining 1 in terms of liquidity position. So you're putting like benefits, how many benefits each will get it, in order to then wait at the end to come up with a decision which company you would invest if you're putting yourself into the shoes of the shareholders. So first we measure the liquidity. 23 minus 7 and 25 minus 22, it will give you the working capital management. This is the one thing. Another thing that we should see deeply what's going on with the liquidity in a deep analysis. The liquidity is the current asset minus current liability, is just showing the working capital management. But what is included in current asset and current liability? It is cash, current receivable, and inventory. So let's see the percentage of inventory and current receivables. So in here, what you can see, guys, 12% is inventory, 8% is account receivable, and 5% is the cash. So what it means that here, for the company to be more liquid in a realistic picture, they should be able to evaluate, like a financial analysis, the account receivable and inventory, how frequently they turn over the account receivable and inventory. Is there any guarantee that the person will be able to accumulate a receivable? So what we can see in here, guys, how much money in real term immediately he has in cash. It's just 5% for East and 10% for West. Okay. One part, before going to this issue, like coming directly to the cash issue, once you can see that before subtracting the current liabilities, like just compare these two variables, just two numbers, 25%, 23%. So before coming to this subtraction and coming to the inventories and the receivables, we'll say that the East has got a priority in terms of liquidity. So that will be wrong, because we need to consider more analysis, more deep analysis in terms of liquidity. It is first to consider what's going on with the inventory. And inventory, we know that they are the goods that are with a purpose, to resell it, or with a purpose to produce a final good. Receivable is something that we sold it and we have not received the money. We sold on the credit basis, so we are about to receive it. So we can see that these two items are higher than from the West. So here's another thing. It's another contribution to the liquidity position of the West. Like the West is getting really strong liquidity position. So which means that cash is here, good. This guy is losing liquidity, but is it enough for you to come up with a decision? Yes, this is enough information that I got it, that I derived it from getting the liquidity information issue. Because as I said at the beginning, from the balance sheet, we are able to derive the solvency issue and the liquidity. Now we're talking about the liquidity. So having the working capital management higher in terms of cash, so liquidity is higher in any case here in West, we said, but it does not necessarily mean that the West is performing well. Okay, it can be liquid. If you remember Islam, we talked in your article and in your guys as well, like there's an inverse relationship between the liquidity and financial performance of the company. So what does it refer to, like having the inverse relationship, like liquidity is affecting the profitability? How come? Who can remind me why it's affected negatively profitability?
Liquidity.
Because excess of cash is not invested.
So when you're liquid, you're keeping the money in your company. You're not investing. So now we're coming with the terminology which is called inefficient of using your assets. So we might think that the West company is inefficiently using their assets, isn't it? So what we can see, yes, we can understand, but when we check the cash, it is the reality comes through actually. The picture that we draw in front of us, we said that the West is unappropriately using the assets, so not in an efficient way. So when we check the cash, yes, the West has got double cash of the East, which means the East has spent all of its cash almost on something. And he sold many things on credit basis higher than the West. And there's many, like 12% of inventory is double than the West. So this means these guys are really, I mean, East is doing something with their assets, but what they are doing, we didn't get it yet. We'll get into that in more detail when we analyze it more. So this is another thing that we should underline in here, that liquidity does not necessarily refer that the company is good. Now, this is the good sign, we go and just invest. Okay, we found it out. For us as creditors, or for us as shareholders, potential shareholders, it's good. The companies can be liquid, but return, we're concerned about the return. We know in theory that the liquidity is always inversely related with the profit, with the return. So we should take these things into consideration as well, guys. Okay, then let's move here. So let's see what's the company is going on in the company, what they are doing. Here, goodwill. Who can remind me what was the goodwill? What does it give you as an indication, the goodwill? Any idea?
It's like reputation of the company.
Okay, but when it appears?
Excess of cash what was paid in when something was acquired.
Good. Acquisition.
Acquisition.
So goodwill is always showing the indication of acquisition. So there is an expansion in the firm is going on. Okay? So we should not be surprised if we find something very strange with the debt as well when there is acquisition. Because when there is acquisition, it means they are paying money. But which money they pay? They use from the capital structure, either equity or debt. So let's come to the debt. Look to the long-term debt, guys. Okay, one might say that, oh, the East has got 58%. It's more than half of its equity, it's debt finance. So there should be a signal to you, a sign that these guys are very dangerous. Why? In terms of probability being defaulted in the future, in the long term. Because if this guy is failing to pay the long-term debt, the creditors will eat them. Like the creditors will not let them to stay alive. They will get everything. If you're a shareholder, imagine if you're a shareholder and if you want to buy a share from this company, what you're expecting to get from it? Dividends, isn't it? So when you buy the dividend, when you buy the shares, you're expected to receive the dividends. If you see this 58% of debt used to finance their assets, that means there's something is going on. These guys is in a dangerous situation. If they go into bankrupt, the creditors will crash them down. So if the creditor is going to crash them down and liquidate, I am as a shareholder will not receive even any penny from it. Because who will get in priority? The creditors. The creditors are going to get in prior times. So in this case, this information can be gathered from here, but still it is not enough to conclude in this way, because this 58% doesn't necessarily mean this guy is in a bad position. So you should be able to identify for which purpose they used it, for what they used to, why did they borrow that much? First of all, goodwill, acquisition. So these guys are expanding. These guys, they are increasing their sales turnover. So these guys are making a really good job in the long term. So in the short run, they are not liquid, but in the long term, they're gonna bring a big, huge markup, a huge profit. So we should be able to take into consideration that well. So goodwill is a good thing. Okay, they are acquiring the business. So that means that 58% doesn't necessarily mean they're in a dangerous situation. So we just cross that. Okay, we don't take this into consideration because now we can get a kind of backup. These guys are buying a new company, and most probably there's something why they're buying. Or there's another question you may raise it from here. What type of creditors nowadays they will lend more money to this company while they have already involved in a lending? If the other creditors, additional creditors are lending money to this firm, it means they're trusting. And the creditors, they will not give anything. I can give you an example, guys. When I used to work in Cyprus in a real estate, one investor came to me. They asked, first thing, do you work with the banks? Why do you think these guys is asking whether we are working with the banks? I mean, whether the bank is financing any credit to the potential customers for the foreigners. Why do you think this guy investor asked me this question? What is the relationship between the creditor and the company? What kind of information you can get from this relationship?
Creditworthiness.
Yes, creditworthiness and the trust. This person is trusted. Why? Because the creditors, they do their job in a proper manner. They evaluate from A to Z. They try to see all the aspects that may affect negatively to the payment. So once the evaluation is passed, the creditworthiness is approved, the trust is underlined, that means the company doesn't have any problem with financial stability in the future. So the bank trusts, the creditors, they trust it. So that means I should trust as well. So this 58%, it's underlined the trustness. These guys are doing good jobs because this is good. And we can see that total liability is 80%. There will not be any creditor, if they see the company is doing bad, if they analyze it, they will not provide any, even a single dollar to this company. But they provided, which means they proved something and they were able to get that loan. They showed that these guys deserve this loan and they got it already. Okay, so in this case, doing this analysis, just using the common size, I would select, if I'm a risk taker, I would go with East Company. Even though the East Company doesn't have a liquidity position, good position, but I don't care about the liquidity now because I'm a risk taker. I'm thinking about the long-term investment and I want to earn the money. I don't care about receiving the short-term period of time money, but I want to make an investment and receive a long-term investment. And you know that in a finance, a long-term investment is always higher than the short-term investment. Returns. So this kind of information we can get by analyzing the common size of the balance sheet. However, it's not still, yet enough. We've got some ratios we have to apply to get a more realistic picture. There's some
Professor, if I may.
Yes.
I don't know. Correct me, please, if I'm right or
Yes.
wrong.
Yes.
If you go back to the financial state, so the balance sheet. In East case, I guess this company is kind of acquiring the financial lease or something because this plant of equipment is almost represented as a long-term liability. It's 80% of it.
Very good.
I mean, I have an idea that
very good.
This is clearly represents something like acquired to like as an equipment to pay out.
Yes.
With future transfer of ownership.
Very good, Islam. It's a very good point. That's what the goodwill says. This 4 million is like they paid 4% higher the amount of the real acquirement, and it is definitely in the proper plant and equipment, whatever they acquired, and it represents 70% of it. So it's a good thing that you just underlined it. So if you're saying that you're not risk taker, you're risk averse, you don't like to get into risk with this debt issue, you can go with the West, like saying that justifying your decision with liquidity position. You like to be more in a safe side. These guys having enough money in just in case if something goes wrong, they will be able to pay the money back, because even their equity is higher than their debt what they acquired. Okay, coming to cash, to the liquidity ratios, that measures the ability to satisfy the short-term obligation. There are three ratios: current ratio, quick ratio, and the cash ratio. Here we can underline, look, current assets or current liabilities. If it's more than one, it's a liquid. It's considered to be liquid. However, there should be a benchmark. In the worldwide benchmark, like in developed countries, guys, in developed countries, it should be 1.8. Okay, the indicator, a good benchmark of being liquid, should be more than 1.8. So every year it changes, like from country to country it changes. But more or less it should be more than 1. But if you everything, it depends on the comparison, of course. If you compare with the benchmark, this is another story. Okay, one side the comparison, one side they given the definition of the liquidity ratios. Like we have current ratio, quick, and the cash. Current ratios is giving a general picture about the liquidity. But if you want to get a realistic picture, like more clear picture about it, then you should go with the cash ratio. You should see what is really this company having in the hand. What are the company has got really cash in hand? Because we know that inventories and receivables, quick ratio, are including the receivables and sorry, the current asset includes receivables, inventory, and marketable securities. However, when it comes to the quick ratio, you subtract the inventory because you are not sure about the inventory. You are not sure whether the company will be able to utilize, to resell their inventories at that time when they need the cash. So that's why they said, let's go with the quick ratio to get more realistic picture about the liquidity. If still you're confused about the receivables, you're not sure that the company will be able to receive all their payments on time, then you just exclude this variable as well. Come up with the cash ratio, the most realistic picture. Just use cash and the cash equivalents over the current liability. This will give you a most realistic liquidity position of the company. However, you should not end up with the decision just going with the liquidity issues, because you have to take into consideration the solvency ratio. As we can see that, as we have seen it from the previous example, East and West companies, East, like the West is outperformed in terms of the liquidity. However, it doesn't say that the West is better than the East, but the East is really work in the long-term position, because the common size, it shows the strategies as well, how they work. Are they working in the long term or are they working in the short-term position? So these guys are working more like on the long term, the East. I'm talking about the East. So if you're the like risk taker and you want to earn really good money, then it's daring, like investing and waiting for a couple years for the long term, because you're gonna be compensated for that, definitely. And when it comes to solvency ratio, it measures the ability to satisfy the long-term obligation, and solvency ratio includes long-term debt equity, total debt equity ratios, and debt ratio, and the financial leverage. These all ratios are showing the leverage, how much of asset is being financed by debt. It's showing the kind of underlying debtness of the company. Is it too much debtness or less debtness? So So when we calculate the solvency ratio, debt should be considered as any interest like bearing obligation. On the other hand, the financial leverage ratio should capture the impact of our obligation and both interest bearing and non-interest bearing. So analysis must understand the limitation of the balance sheet ratio analysis. So when you compare the peer firms, they are limited by difference in the accounting standard and estimates. So we don't know how they are using their inventories and receivables. How do they estimate? So we should get into details and we should be able to try to understand what kind of methodology they use to estimate the inventories or receivables and so on. Lack of homogeneity, as many firms operate in different industries. Like it's not only the industries, it can be in a different countries, like comparing different banks now. Islam and you guys are all doing comparing, like Islam, you took 11 investment EBRD, for example. You have not compared the bank, but you took them as a single classified a group of countries, assuming that they are all same. They're like assuming they are all homogeneous. However, it's not the case in reality, because they have different financial system, they have different standards accounting, they have different economical political standards. So it affects definitely all the analysis that you're involved in actually. So this is another thing that you should take into consideration when you interpret the ratio. It requires a significant judgment, and balance sheet data are only measured at a single point in time. So it's not enough to go only with the balance sheet and the income statement. You should be able to take into consideration the cash flow statement as well in order to make a really good analysis. The cash flow statement we're gonna go through next week, and we'll finish it, and it will be our last chapter for this, and then we're gonna have the final exam.
When we will have a final exam?
We will discuss when we finish the cash flow statement chapter.
Okay.
We'll discuss. We'll find out the most appropriate time for us.
Professor,
Yes.
What about financial analysis techniques topics, which are according to
unfortunately, we will not be able to finish it. We are on last week. Next week is the last week, and we are mostly spending I'm just trying to finalize your article. I want you to give maximum knowledge that I have to share with you, so that it will be easier and helpful for you to write the article thesis in a good and a proper way. Okay.
Okay.
So I'm gonna share the more information with you concerning the technical parts of the financial analysis. Then you might study yourself alone after when you finish the lectures itself. Okay. Okay, let's go over the questions in here. At the beginning of the year, a parent company purchased 500,000 shares of sub-incorporated for $15 per share. Just before the acquisition, the sub's balance sheet reported net asset of $6 million. The parent determined a fair value of sub's property equipment was like $1 million higher than the reported by the sub. So what was the amount of goodwill should parent report as a result of its acquisition of sub? So first of all, we should determine the purchase price. Purchase price is 500,000 shares times $15 per share, which is $7.5 million. Then you should come up with the goodwill. And goodwill, we know it's a purchase price minus fair value of total assets. So goodwill is purchase price, which is 7.5 million, minus net fair value. And what is our net fair value in asset? The net asset was 6 million, and we know that it was higher. It was reported by 1 million higher, so it's just equal to 7 million. So our goodwill is equal to 500,000 bucks. Okay, this is the question. We can select B. Do you have any questions? I can proceed to another one. Okay. Any questions? No questions. So at the beginning of the year, the company P purchased 1,000 shares of company S for $80 per share. During the year, the company S paid dividend of $4 per share at the end of the year. So company's S share price was $75. This is the information is given. What amount should company P report on the balance sheet at the end of the year if investment company S is considered as a trading security? So you remember we did 3 scenarios: trading, available for sale, and held to maturity, and how to record them in a other comprehensive as a gain and loss, etc. So the same thing in here we should calculate. So what amount should be reported if the investment considered for available security? So let us calculate. Actually, in here the calculation is straightforward. You should be able here to identify what will be the asset value in here at the end of the year. It was, look, you remember how they're recorded. One is at historic price, at historic cost. The other one at fair value, fair price, which means the market price. So if at the beginning your assets were equal, if you purchased the share, they were equal to $80 times 1,000 shares, they would give you 80,000 at the beginning. But we know the price fall to $75. So then in both cases, it should be the same. $75 times 1,000 shares is just 75,000. So in trading a whale, because we know that we record in the scenario trading a whale for sale at fair price. And it will be always updated. Okay? But what was the difference between the trading and a whale for sale? In trading, we purchase with the purpose to resell it and to make some markup. But in available for sale, we purchase neither to resell or to keep till the end. We just keep it for a while, just for more than 2 years, 3 years, and then later resell it, not with the purpose to make a really good markup. In here, once we see that there is a markup, we just immediately sell it in a trading case. Okay, question 11. What amount of investment income should company P recognize in its income statement? Look, income statement, if the investment company is considered trading, and what it should be recognized if the investment considered for available sale. So now we need to select one of it. One is in the income statement as a profit, as a revenue, or gain or loss, or how we call it. So let us calculate. First of all, when it comes to the trading part scenario, in a trading scenario, first of all, what kind of, in the income statement, we receive what by buying this dividend of $4 per share, isn't it? We're gonna receive $4. So this is what we concern. We're gonna receive $4 per share. How many shares? 1,000 shares. This will make $4,000. Good. Then we receive, or actually we do not receive in here, we incur a loss in here. Why? Because we suppose that we expected that the price is going to increase, but however the price did not increase, the price became $75. In here we are losing $5 times 1, because we are losing by $5. It was 80 and we paid 80, but the price became per share became 75, so we are losing here 5,000 bucks. So in total we will have 4,000 minus 5,000 minus $1,000 of loss. This is the loss. This is a trading scenario. And let's come. So we select minus 1,000 in the bracket. Okay, we can put it in a bracket more properly. So for trading, so A or B, we can see definitely. So let's go for available for sale. In here, we are not caring about reselling because we will keep it. We are not, we haven't purchased this shares with the purpose to resell it to make some markup. We purchase it to keep for a while and then resell, not till the end of the maturity, but for a while. So we will care only about the dividends payment, which is 4 times 1,000, which will be equal to $4,000. So we can see that is B, minus 1,000 and 4,000. Okay. Any questions?
So, Professor, in a available for sale case, we're gonna unrealized gain or loss. It's gonna go to unrealized gain or loss. That 5,000.
Yes. In trading scenario.
Uh-huh.
Yes, it will, but in the income statement. Let me just show it to you in where it will go to make you more clear about it.
Yeah, I just forgot that.
No problem. I'm just opening it for others to review it because you cannot remember the balance sheet and etc. how it's recorded. Just to remind you. Here you go. Here, it will go to this side. Dividend will be here.
Yes.
And loss will be here. Okay?
Yes, but
and how much you have it in here, it will be recorded in this part.
yeah, I understand.
So, and the loss will be here as well. You want me to try in Excel to show it to you?
No. What I'm just curious about is that in one case we did not touch it. I mean the 5,000 loss, right? Unrealized gain or loss. 5,000 of down price that the price went down?
It was available for sale. We are not trading it.
Yes.
In here, it will be dividends only, 4,000.
You're right. So the question asks, for example, here that income statement only, right? Because
Yeah. Only the income statement. We are concerned about the income statement.
yeah, because if you go back, there is in asset sides, there is that.
Yeah, here we have loss and gain here as well.
Yes,
but we are
yes.
not touching this. We are not touching this. We are asked only to show the effect on the income statement.
Okay, clear now. Thanks a lot.
Okay. Coming to the question 12, the Miller Corporation has 160,000 of shares of common stock authorized. There are 92,000 shares issued and 84 shares outstanding. How many shares of treasury stock does the Miller own? So it's very easy and simple. What are you doing here? You just go with, we know that basically if in the company there is no treasury stock issued before, so there's zero treasury stock, that means that number of the shares issued will be equal to the number of shares outstanding. If there is a treasury stock, that means they're the shares that should be repurchased back. So number of the shares was issued in total 92,000 and only outstanding 84, which means that you should repurchase back the difference amount between 92,000 and 84,000. Sorry. So 8,000. A. Okay, let's move further. Okay, in here we're given the balance sheet at the end of the year. 150,000, 86,000. 150,000 is investment in a company at fair value. Deferred taxes 86,000. Common stock 550,000. Preferred stock $100 per value with 175,000. Retained earnings and accumulated other comprehensive income. Investment in beta company had the original cost of $120,000. Assuming that investment in beta classified as available for sale, Alpha's total owner's equity at the end of the year is equal to this amount. So we need to calculate what is the owner's equity, or owner's total equity, first of all. We need to classify which one is equity, which one is, and that they will sum it and we'll be able to find. So here we've got the balance sheet and we need to classify, first of all, what is included in total equity. First of all, in here, the investment is not included. Why? Because investment is an asset. It's nothing to do in here. So we just exclude directly. Deferred tax is not included. It is in liabilities. We're not concerned. Common stock is included. Preferred stock is included. Retained earnings is included. And accumulated other comprehensive income is included. So we need to just sum these variables, these numbers, and you will get total equity equal to 1 million something. Just let me see. 1 million, if you just sum it up, it should be 1,664,000, this number. So we are summing up just this. Okay. So these numbers, if you sum it, you're gonna get exactly this number. Okay. Any questions, guys? It seems you don't have any questions. It's good. So we are done with the chapter 5, or sorry, with the chapter lecture related to the balance sheet. And we know some from the income statement.
Professor, I have a question.
Yes, please.
Will we have this document in the Moodle, this CFA practice?
I will have to talk to one person to ask the permission to share. If he allows me to share, I will share it.
Okay, thank you.
Okay, I have to talk to this person. Then if he lets me to share, then I will share definitely for sure. Okay, if you don't have any questions, I want to move to stata. There is something that I want to share with you, and I want to give you kind of guideline what you should do in empirical results, what kind of analysis you should come up, first of all, and what kind of test you should do before running any empirical analysis. So basically, in stata, when we do any empirical analysis, in any research, first thing that you should be doing is the test for stationary, like, or test for unit root test. Whether there is a unit root test, whether they have a long run relationship, the variables, or not, then we can go with simple OLS. This is the first thing that you should do. Second, I'm going to show you how to do it. So in your article, I expect this test, like you did the test. This is the stationary. You did the test, whatever the case. So first, test for stationarity or for unit root test. So in order to proceed with the OLS or GLS, our data should be stationary. Otherwise, we cannot run it, or we have to use another different models. Second, we have to test for serial correlation or autocorrelation. It is the showing. So if there is a serial correlation in your variable, if there is autocorrelation, then there is a big problem, which means that your results will not be good. Your results will not be validated. So you have, if there is, you have to eliminate. How we are eliminating, I will show you as well. But today I'm going to spend the time on showing the test. First of all, you will do the test in your empirical results. You will show me the test, the table of the test that you did for stationarity, table the test you did for serial autocorrelation, table that you did the test for the third, which is test for heteroscedasticity. Yes, correct. Test for heteroscedasticity, the distribution of the error terms. Are they distributed normally or they are heteroscedastic? So why we need to know the distribution? Because heteroscedasticity is responsible for R square. So what is the R square, guys? R square represents how much your changes in your dependent variable is being explained by changes in independent variable. Let's say 50% you found it. 50% changes in your GDP or 50% changes in your profitability can be explained by 50% changes in independent variables. But rest of the 50%, half of it, you don't know how to explain it. That comes from the error term. So in order to predict it, in order to take under control that 50%, it should be homoscedastic. If your data is not homoscedastic, that means it is heteroscedastic, and you cannot control it. You cannot know it. So that means the result will be biased. So we need to have a validated result. So we will check for heteroscedasticity. If there is heteroscedasticity, we will eliminate as well. I will show you how to eliminate as well, but not now, next time. But this time you have to be able to do the test. And the last test is test for multicollinearity. We're using WIF model here, variance inflationary factor, that tests the correlation between independent variables. The last one you already know. So these three things that you should know as well. So this 4 tests you apply in order to get validated results, or we can say robust results. So wherever, what kind of research you do, wherever you do it, if you are using OLS or GLS, you have to apply this. But when you use the system GMM with one shot, it kills everything. But you're not going to use the system GMM. You're going to use fixed effect or random effect, one of it. We'll choose it. But after, when we test for these variables, for these issues that you may have it in your data. So whenever you write your thesis, you will be asked to do so. So this is the things that you are asked to do as the first step in your analysis, before starting your analysis. Is that clear, guys, with you? Can I proceed further?
Professor, so should we test all of them or only one?
Yes, no, you're gonna test all of them. Because
in
I
our
want
paper
you,
too.
yes, I want you to write a really good paper, so it can be a really weighty paper, so that you can publish it and you can use it to get some benefit from it. I want you to learn from my class, so that in the future you will use it. Okay. If you don't have any questions, I'm starting with stationarity, then serial correlation, heteroscedasticity, and multicollinearity. The first, this 1, 2, and 4 is very easy. 3 is a bit long, it has got the longer way of doing it, but it's a matter of memorizing the commands. That's it. Once you memorize it, that will be done for you. If you don't have any questions, I'm just clearing everything, starting the analysis. So I will go for data, import, so I'm declaring the data. I have to declare that this is the panel data. Next is set ID year. Okay, it's a panel data. Then I go with regress. Let's say my profitability name, theta, NPL, CI, liquidity, and GDP. Okay, this is my variables. Regression. Okay, I don't have to do the regression, but I just want to show you my model. Okay, I have 1, 2, 3, 4, 5, 6. 6 variables, okay? Now, first I'm doing stationarity. I go statistics. I can type a command, but let me go to first statistics. Longitudinal panel data, because I am using panel data. You are using panel data as well. You're not using one country, you're using more than one country, your panel data. Unit root test. Okay, I go here. Last time I shared the information by using EViews to Islam. He saw it. I can choose Pasaran, I can choose 11 Lenchu. Let me choose 11. Now I'm choosing the variables. My first variable, NIM, is here. Okay, I will test first of all NIM. Unfortunately, it requires strong balance sheet. But let me choose the Pasaran then. Still, this guy still doesn't let me to do it. Your data should give the results, because my data is based bank specific, based on the banking. That's why I have many missing values. That's why it doesn't take into consideration the stationary. So in your case, it should give the results. Okay, guys? But if I do it in EViews, it should give me, but the stata doesn't take account. So this is the advantage of EViews. It does calculate the stationarity here. My EViews, if I run it, it's quicker. So it's better to use both programs, guys, actually, for you to know when you do the first of all. It's more or less the same. They work in the same way. My date is okay, guys. Let me return back. I will do the stationarity at the last stage, because let me finish with the stata. So let's keep the first step in stata. So where you go, statistics, panel data, and unit root test. I didn't appear. Ah, here it's appeared. So because of I'm sharing the screen, it doesn't show up. Okay, anyway. So statistic, panel data, unit root test. You choose the variable, run. That's it. It gives you the results, whether it's stationary or not. If it's significant, it is stationary. If it's not significant, it's not stationary. So coming to the serial correlation. XT serial is equal to so if it's significant, it shows that look, null hypothesis says that no first order autocorrelation. If I do not reject the null hypothesis, then I will accept it. I will say that there is no autocorrelation. However, I reject the null hypothesis. I say there is autocorrelation. So significance shows that there is autocorrelation in my model. So in NIM. Where is regression? We're gonna test with theta. Autocorrelation here as well. The unit root test. So autocorrelation, serial correlation. So we checked it for NPL. Same is significance. Then go I with CI. Or I can just put all of the model here. It can give me, I don't need the ROE. It should give me actual biologic. Liquidity, and I put the GDP. Yes, as you can see, there is autocorrelation. So Wooldridge test for autocorrelation in panel data, it shows there is autocorrelation in the first order in the whole model. You can check the by one, or you can check as a one model, like spread all the model, and you can check it like this. So there is autocorrelation. So second test, we did it. So there is autocorrelation. When you do it, you create a table like that measures autocorrelation, measures the multicollinearity width, that measures the stationarity for each variable. And then third test, okay. Stationarity, we said, is easy as well. It's linked with linear data unit root test, and we select the variable, we submit, and we get the result. If it's significant, stationary. If not, then it means it's not stationary. In your case, your variable should be stationary, as I know. Anyway, we need to check it. So coming to heteroscedasticity, to the third test. The test, we did it. Here we go, screenshot. Here, test for stationary, we did it. For autocorrelation, we did it. Now for heteroscedasticity, we need to do it to see whether there is a heteroscedasticity or not. How do we do it? First of all, XTGL. First of all, let me type the here. My model. This is my model. XTGLS. This is the command I'm typing. Comma. IGLS panels. Open the bracket. Hetero. Close the bracket. So we should wait a little bit. Estimate, store, hetero. We need to save the results. I saved it. So I run for heteroscedasticity. Now I save it. Now I'm going to run for homoscedasticity with the same model, but without these panels, hetero. So if I don't use these panels hetero, it means I'm running for homoscedasticity. If it's homoscedasticity. Now you can see panels is homoscedastic. In here, panels is heteroscedastic. So this one I should save it as well. Estimate, store, homo. I'm gonna name it. I saved it. Okay. Now I need to type another command, which is very important as well. Local df, degree of freedom, e, number of observation, slash from below, g groups, and -1. This is command which is given to test whether it's a hetero or homoscedasticity. Okay. Now we can run the test itself. Lagrange test, LR test. Hetero. We can put homo or dot. df 104. Estimation result not found because I did.
I guess you said homo or you put homi.
Oh, good. Yes. Thank you, Islam. You're already in. Good job that you really figure out. Now, we have heteroscedasticity in here. In our model, we have a heteroscedasticity. So there is autocorrelation, there is heteroscedasticity, there is everything. So the results, whatever you get from the OLS, will not be that much trustable. So we need to get rid of it. So let me summarize all the things that I did it. Whatever we did it in here, it was this. For test for heteroscedasticity R square and everything. But the comments, let me share the comments with you as well, first of all.
Professor, one more thing. When you print out the results, how do you do it? Like, I mean, you just simply convert it to PDF?
No. A good way to do it, if you're going to put it into thesis, what you should do, you should put it in a proper manner. The proper manner, like the mainly all journals requires, and by thesis requirements, of course, it should be, let me share my results that I'm just preparing nowadays. For example, data. This is now here. Can you see? I'm using just coefficients. I'm using just coefficients. This is lagged by 1 year back. This is bank specific variables. This is industry specific variables. This is macroeconomic variables. And this is dummy variables. I just categorize them so that when any reader who reads it, he can easily follow. This is for all banks. This is net interest margin. This is non-performing loan. This is conventional bank. This is Islamic banks, for example. I separate like this, but I'm using only coefficients. But how do I know they are significant or not? When I transfer it to here, I directly check it. If it's significant, at what level? For example, when I put 3-star, I give here definition. If it's 3-star, denotes a significance levels at 1%. If it's 2-star, it denotes a significance levels at 5%. If it's just 1-star, it denotes significance levels at 10%. This is the description. So normally the table should be like this.
But how do you convert it from stata?
One by one. Let me show it to you. For example, I want to get the coefficient, this coefficient. I need this coefficient only, yes? Nothing more. The probability, I can see that they're all significant. I just copy as a table.
Okay.
Put it in here. Just paste. You can see. So for example, I don't need this. I need the significance and this value. So for example, I start putting the stars here. 3 stars here. 3 stars here. 2 stars here. 2 stars here. And so on. Then I just copy this variable. First of all, I create the table and just copy, cut, and paste in that table. I don't need this. I need them only to put the stars. When I put the stars, I just delete everything. And it works like this for all data that I put it.
Okay, clear, thanks.
So 4 tests, you're going to do it. But let me quickly show how I'm doing in EViews so that you can just, okay, final data I have since 2018 to 2011. And it is how many banks? 355 banks. Okay.
eViews is also easily downloadable.
Yeah, it's eViews is not easy downloadable, but I have the eViews I can share with you. You have to crack it.
Okay, we're ready to do that.
Okay, but it's good to have eViews and stata, because something that you can do in eViews, yeah, you cannot do it in stata. 2011, 2018, and it's a balance panel data, and the number of the cross observation 355. Yes, okay. And for example, I'm gonna use only first these variables. ROA, NIM, ROA, these things only. First 5 variables only. So I put it here, I type before them data. When I type the data, I give a command. And just here, I just press enter. I create the work file. And then just go to Excel. Go here and select all, whatever I just made it. Come on. So I go to eViews and I paste it here. Let me just check it. Okay, not I will, not I will. Okay, I don't care. Then just I press it, for example, net interest margin. Then I go to view, unit root test. In here, what I like it gives you for all methods of unit testing for unit root test. Here we go. Levin and Chu, Pesaran, Fisher, ADF, and PP and Fisher chi-square. So all of them are significant. My data is stationary. So I can check the stationarity in here. And same thing, we can run the OLS in here, estimate the equation. Like NIM, theta, NPL, and PLTL. And just press OK. NPL. Here's the regression analysis. Directly comes here. So regression analysis, whatever you get it here, it will be exactly the same with the regression analysis you get it in stata. There shouldn't be any differences. And here I can change it like fix and the random effect in here easily, but in stata you have to write the command and give the command, etc. So in here it's like more friendly user, the eViews. If you're gonna run, for example, system GMM, it's not good to use this one. It's not a friendly user then you have to go with stata. But OLS, stationarity, and everything, you can check it in here. For example, guys, one thing. No. I will let you go, sorry. Regression, here we go. So this is our regression. What we can do in here, for heteroscedasticity, some authors, they use graphing, RFE plots. So you can see they're scattered, like they are not dispersed, like they're all coming in one single, like there's some pattern here. Here we go. So it's shown a direct indication there is a serial correlation. Or sorry, there's a heteroscedasticity that all variable, these error terms like fitted values, residuals, are going in some direction. They're increasing and down, increasing. They're like accumulating in one place and they're going down. But in order to be, for variables to be non-heteroscedastic or homoscedastic, they should be dispersed in here. They shouldn't have any direction. They shouldn't have any pattern. So some authors, they use graphing to test for heteroscedasticity. This is residual, like error terms graphing. Okay, guys, I'm not going to take your time more because you've got another class. So this will be uploaded video in Moodle as well. You can just go if you want to check how the coding works and everything. You can just go and run it again. So for your thesis, anyway you're going to write the thesis, anyway you're going to write the article, you have to do this all 4 tests in order to make your job easier and validated. Of course, it will not make easier, but anyway, it will help you. This is what I'm trying to say, actually. Okay, I'm stopping the sharing.
Okay.